Hello and welcome back to ETF.com. I'm Rebecca Hampson, European Editor, and I'm joined again by Alan Smith, Chief Executive Officer at Capital Asset Management, for the second of our 3 sessions focusing on portfolio management and ETFs. Today we're going to look at how the retail distribution review affects passive advisors. Alan, hi, welcome back.
Thank you.
So my first question for you is, how does RDR affect advisors using a passive approach?
Well, what I see RDR has done significantly is to introduce a huge degree of transparency to the market that wasn't really there before. So with that comes a focus on value as well as cost. Now, using passive or index investing isn't necessarily all about cost. It's more, in my opinion, about value. So what RDR has done has encouraged people to look more to delivering a value proposition, and that's led naturally to examining a passive approach to investing.
So has RDR lowered costs?
By and large, it has done so far, regardless of the investment approach that people are taking, active, passive, or anything in between. Because of this, as I say, a clear focus on transparency, most of the investment groups have felt under pressure to reduce their fees and costs.
And are advisors more knowledgeable now about ETFs and trackers because of the higher requirements on qualifications?
Well, yeah, that would appear to be the case. Most advisors that I see are very passionate about maintaining their independence as a business. And therefore, in order to do so, they're going to have to really understand all the investment opportunities that are available to retail customers. And that would certainly include ETFs, passive investing, a number of other investment approaches. So advisors have had to find themselves improving their knowledge and increasing their education around the whole story of ETFs.
And can advisors keep this label of independence if they are only able to use passives?
Well, the short answer is no, they can't. And we very much take the approach with any client that we deal with, that we've got a completely sort of open policy. We do not believe that we're going to shoehorn, to use the regulator's word, shoehorn clients into index or passive portfolios before they walk in the door. We will go through a very detailed process with them, starting with the whole market. And in order for us to maintain our independence, that's the approach we must take. We will, over time, through a very detailed process, we will eliminate investment opportunities that we believe are less appropriate. And that often, but not always, but often leads to a 100% index approach to investing.
So I should really ask this. I mean, how has RDR changed your business?
It's been a great boost to our business. It's been very positive. This increasing focus on transparency and understanding what people are paying for the proposition. Let's face it, this is not about, as I said before, being really cheap. This is about delivering value. None of us mind paying for whatever it is in our lives, but what most of us are keen to ensure that we get is value for money. And therefore, we're a business that is quite keen to show a value for money proposition. Other organisations may struggle to deliver that at the cost they're currently charging.
Alan, thanks very much. Good to see you again. Tune in again for our next instalment on portfolio management and ETFs, where we will focus on how to pick a platform when investing in ETFs. I'm Rebecca Hampson, and thank you again for watching ETF.com.